This is Muhammad Majidul Haq Khan. Hello, dear students of class 9 Business Studies English Medium morning shift. How are you? I hope that all of you are well by the grace of Almighty Allah. Today, I would like to share with you about capital budgeting of finance and banking, which is included in chapter 5. In the term capital budgeting, capital relates to the total funds employed in an enterprise as a whole. Budgeting indicates a detailed quantified planning which guides future activities of an enterprise towards the achievement of its goals. Capital budgeting may be defined as the decision-making process by which a firm evaluates the purchase of major fixed assets, including building, machinery, and equipment. So, capital budgeting is the evaluation process of investing money in the fixed asset. Say for example, if a grocery shop owner would like to purchase fish, or if any garments owner would like to purchase modern machine for his factory in order to increase productivity, then it is included in capital budgeting. Now I would like to discuss about application of capital budgeting or area of capital budgeting. Capital budgeting is applied in all aspects of long-term investment decision. Capital budgeting typically involves substantial or huge amount of expenditure. Thus, this decision depends on planned financing. The area or application of capital budgeting are given below. Number 1, fixed asset purchase. To start a new business, every business organization is to purchase fixed asset like land, building, equipment, furniture. In any types of business which incurs fixed cost, is required to apply capital budgeting process before purchase any fixed asset. In running business, sometimes fixed asset may become obsolete. That time replacement is required for the fixed asset. And in this case, business people can take decision by the application of capital budgeting decision. Next point, business expansion with the intention to increase the production capacity. In case of running business organization, production capacity is required to increase by the installation of high capacity machine. This purpose can be fulfilled. So, decision of purchasing a high capacity machine can be taken after proper evaluation by the application of capital budgeting technique. That means if any business organization owner would like to increase production capacity, definitely they have to either expansion of business or to install new machinery or to increase the number of unit of production. In all of these cases, capital budgeting decision is applied. So to take these decisions, owner calculate the cost of purchasing machine or to cost of construction of building. By this investment, how much income will increase is another most important measuring factor in purchasing decision or construction of building. All this calculation can be done by the capital budgeting technique. Next, product diversification. New product may be marketed along with the existing product in the market to extend the business of the company. That means product diversification means to add new product or new service with the existing products in order to minimize the risks of business. For example, ABC company is currently producing mango juice, and in this case, as a part of product diversification, they would like to add apple juice, guava juice, which is known as product diversification. In case of marketing a new product, decision maker at first is to collect information regarding the life of new product, calculate the cost of production, market demand, and expected income. To find all this require applying the capital budgeting decision. Then replacement and modernization. As firms' growth slows and it reaches maturity, most capital budgeting made to increase efficiency by replacing or renewing obsolete asset. Obsolete means no longer in use or worn out asset. Say for example, if a salon owner thinks if he can afford to purchase some new or modern technology based machine in order to increase the efficiency in the haircutting job, then he needs to make a comparison between the incremental cash outflow of the decision and the incremental cash inflow by the decision. If the incremental cash inflow is higher than the incremental cash outflow, then decision should be accepted. It is the another application of capital budgeting decision. Besides this, modernization is also applied in case of capital budgeting decision. In order to cope with the changing circumstances, business should be modernized. So, substantial amount of money is required to modernize the factory or the production process. Now, I would like to discuss another topic, process of capital budgeting, which are mentioned below. Capital budgeting process, there are three steps required for capital budgeting in long-term investment decision. Number one, expected cash flow. 2. Discount rate measurement. Number 3. Capital budgeting technique selection and application. Cash flow estimation is the first step of capital budgeting decision. To estimate the cash inflow, every business has to identify the expected sales amount, expected current expense, cost of capital, and other expense. Basically, cash flow means the total amount of money being transferred into and out of a business. It is the net amount of cash and cash equivalent being transferred into and out of a business. Here, cash inflow means it is the money going into a business. In business, cash inflow occurs from selling of goods and services. Cash outflow is the amount of cash that a business disburses. Cash outflow occurs from current expense, cost of capital, and from other expenses. Next, discount rate. Discount rate is also the process of capital budgeting. The rate at which future cash inflow is converted into present value is called discount rate. Though the amount of cash flow in the future consecutive years are equal, but in present value context, they are not same. Present value of future cash flow differs with the project expected life and discount rate. That means the later the cash flow, the lesser the present value if other things remain equal. Other things remain equal means if the discount rate and amount of money from the project remain unchanged, definitely later the cash flow, the lesser the present value. I have given an example to make you understand. That means as cash flow of any project is carried for many years, so to select a suitable project or investment opportunity, business needs to apply the capital budgeting techniques to discount the future cash flow. Through discounting process, future cash flow of the project is converted into present value. If the present value of future cash inflow is higher or greater than the present value of invested money, then project should be accepted. And in capital budgeting, the cost of capital is regarded as discount rate. Last points, application of capital budgeting technique. After estimation of cash flow and discount rate, capital budgeting techniques is selected. Different techniques of capital budgeting are being used in project selection or evaluation, but all techniques were not accepted equally. Every technique has some advantages and disadvantages. Project is selected by considering the nature, risks, and other issues of the project. So these are the process of capital budgeting. From today's lesson, we have learned about what is capital budgeting, what are the application of capital budgeting, and different steps of process of capital budgeting. And your home assignment is explain the first step of capital budgeting process Second, what is mean by discount rate? 3, why is capital budgeting assumption based? And 4, why is product diversification done? These all questions for 2 marks. So that's all about today's lecture. Thank you very much.